Hi, I'm Amy Irvine, founder and financial planner for Rooted Planning Group. Welcome to this month's 2-minute summary. We hope you like this summary of what's gone on in the past month with the market. If you do, please like and subscribe to our YouTube channel, as we would love to have you be aware of whenever we release video content. Over the past month, we've seen some increase in the overall market, and when I say market, I'm referring specifically to the S&P 500 index. You can see year to date, it is up 7.7%, following a pretty significant downward trend in 2022. Quick recap, the S&P 500 ended down 18% for 2022, and as I mentioned, is up about 7.7% so far this year. Notice on the chart, however, that there is a negative 2% in the 2023 column. So that means at one point in time, the S&P 500 was reflecting a negative 2% return somewhere in the month of January. This chart I really love because it shows total returns of the S&P 500, that's the bars, and the largest intra-year decline, that's the dots for each year. So the average you see, could be a significant drop. However, it could still end in positive territory throughout the course of the year. We like to show this because we think it really stands out. So what I was referring to is in 2023, like I said, we're up about 7.7%, but the S&P 500 was down at negative 2% at one point in time throughout the course of this year. That is one of the reasons that we encourage people to stay in the market, because we don't know when the recovery is going to start. I know you've seen this chart before if you have listened to any of the prior YouTube videos I've done, but it shows the 24 stock market corrections since World War II, and the average correction sees a full market fall about 14.3%, taking about 5 months, and then the recovery tends to take about 4. But there's a period of time in the middle. It doesn't like fall 5 months and then recover in 9. So we just don't know when that recovery is going to start. That's why we encourage people to actually stay in the market. Quickly just showing you what happens in a bear market and the recovery. So in a bear market, we typically see a 34% or almost 35% decline in an average bear market, and it takes 2 full years. I think what has happened in 2022 may be somewhere in the middle. Quickly touching base on interest rates, that's been a big topic, and I'm going to get into this much more in the 10-minute summary, but you'll see that there's still an inverted yield curve within the interest rate. So the 10-year is lower than the 2-year. That's called an inverted yield curve. That can be a leading indicator to a recession. And we've noticed that economic activity indices have fallen across both the non-manufacturing and the manufacturing. Numbers above 50% represent economic expansion, while those below suggest contraction. Clearly on this chart, you see contraction. And wrapping up this summary, you'll see that asset class performance, the balanced portfolio, was somewhere in the middle for the last 4 years, basically. It's slightly below the S&P 500 as of this point in time, as of February 2nd. But the year is early. We'll see where it ends up. But this is exactly why we tell people to, have a balanced portfolio, because as you can see last year, if you were somewhere in the middle, you captured some of the upside and didn't fall as much as the downside. We hope you've enjoyed this presentation. Here's some quick definitions if you want to dig into some of the terminology that's used in this video. And just as a reminder, please don't forget to like and subscribe to our YouTube video. We'd love for you to be aware of whenever we release something new.